The economy is slowing down. Companies are laying people off. Your investments are bleeding red. And every single headline screams the same word: recession. And you know what most people do the second they hear that word? They panic. They make emotional decisions. They do exactly the wrong thing at exactly the wrong time. Today, we are going to make sure you are not one of those people. Welcome to Arthur Logic, where we break down finance, investing, wealth building, and money psychology in plain English. No suits, no boring lectures, just real talk that actually makes sense. If you are new here, hit that subscribe button right now, because the stuff we cover on this channel, it is the money education nobody taught you in school. All right, here is what we are covering today. What a recession actually is, not the scary media version. How it hits your job, your savings, and your investments. And most importantly, what smart people do during a recession while everyone else is losing their minds. Let's go. Let's kill the fear first, because half the panic around recessions comes from people not actually knowing what the word even means. A recession is officially defined as 2 consecutive quarters, that is, 6 months, of the economy shrinking. GDP goes down, business slows down, money moves slower through the system. That is it. It is not the apocalypse. It is not the end of money. It is the economy doing what it has always done, going through cycles. Up, down, up, down. Like your motivation on a Monday morning. Here is something the news will not tell you. Recessions are normal. Since 1900, the US alone has experienced over 20 recessions. And you know what happened after every single one? Recovery. The economy came back. Every single time. So the first thing smart people do during a recession? They zoom out. They stop watching the daily headlines like it is a horror movie, and they remember that this is a cycle, not a catastrophe. Now let us be real, recessions do hurt. Let us break down exactly where you feel it. Jobs first. When companies make less money, the first thing they cut is headcount. Unemployment rises, hiring slows down. If you are in an industry that is sensitive to economic slowdowns, retail, real estate, advertising, hospitality, your job security drops. This is why your emergency fund is not optional. It is non-negotiable. 3 to 6 months of living expenses, liquid, in a savings account, before you do anything else. If a recession hits and you have no cushion, every single financial decision you make from that point forward is driven by desperation. And desperation is expensive. Savings next. Here is an interesting twist. During recessions, interest rates often get cut by central banks to stimulate the economy, which means the interest you earn on your savings account goes down too. Great, thanks for that. But here's the thing. Your savings still protect you. Cash during a recession is actually powerful because everything gets cheaper. Assets go on sale. More on that in just a second. Investments. This is where people really lose it. Stock markets drop during recessions, sometimes 20%, 30%, even 40%. You open your investment app, see your portfolio bleeding red, and your brain just screams, "Sell everything." Do not do that. Selling when the market is down locks in your losses. You go from a loss on paper to a real, permanent loss in your pocket. The people who panic sold in 2008 or March 2020 missed the biggest recoveries in market history. Panic is not a strategy. This is the section that actually matters. Because while most people are panicking, smart money is quietly making moves. Move 1. They protect their income first. Before thinking about investing or growing wealth, smart people audit their financial position. Are they employable? Do they have skills that are recession-proof? Do they have that emergency fund locked and loaded? You cannot play offense if your defense has holes. Move 2. They do not stop investing. They keep going. There is a concept called dollar cost averaging. Sounds fancy, super simple. It means you invest a fixed amount regularly, whether the market is up or down. When the market drops, your fixed amount buys more shares at cheaper prices. When it recovers, those cheap shares grow in value. Recessions are basically a sale on investments. Smart people shop the sale. Scared people hide from the mall entirely. Move 3. They cut lifestyle expenses without killing themselves. Recessions are a natural moment to audit your spending. Not to suffer, but to cut the stuff you do not actually care about. Subscriptions you forgot you had. Dining out 5 times a week. Impulse purchases. Redirect that money to your emergency fund or your investments. That is the move. Move 4. They do not make permanent decisions based on temporary conditions. This is the psychology piece, and it is the most important one. Recessions feel permanent when you are inside them. They never are. The people who sold their homes at a loss in 2009 and then watched prices double by 2015. The people who pulled out of the stock market in 2020 and missed a 100% recovery within just 18 months. Temporary pain, permanent consequences, because they let fear drive. Smart people feel the fear and make logical decisions anyway. That is literally the whole game. Here's the reframe I want you to carry out of this video. Most people see a recession and think, danger. Smart people see a recession and think, repositioning opportunity. Every major wealth transfer in history has happened during or just after an economic downturn. The people who came out ahead were not lucky. They were prepared. They were calm. They had cash, a plan, and the emotional discipline to execute it while everyone else was screaming. You do not need to be a genius. You just need to not panic. That is the edge. So let us wrap this up. A recession is a normal economic cycle, not the end of the world. It hits your job security, your savings returns, and your investment portfolio. But the damage it does to most people is not from the recession itself. It is from the fear-driven decisions they make because of it. Build your emergency fund. Keep investing consistently. Cut the waste. And zoom out. Here's your question for the comments. When you hear the word recession, what is your very first instinct? Fear? Opportunity? Something in between? Drop it below. I genuinely read every single one. If this video helped you think differently about money, like it, share it with someone who needs to hear this, and subscribe for more finance content that actually makes sense. Stay logical